In our last video, we have discussed 3 pieces of law shaping the banking industry after the Great Depression. In this video, we will further discuss more recent developments in securities regulation. We will be covering Greenwich-Bliley Act of 1999, Sarbanes-Oakley Act of 2002, and Dodd-Frank Act of 2010. As we have discussed in our last video, commercial and investment banks were not allowed to operate within the same entity under the requirement of the Glass-Steagall Act of 1933. The separation of commercial and investment banks had already been gradually weakened through time. In year 1986, the Federal Reserve allowed bank holding companies to participate in the underwriting of corporate issues under the condition that this type of non-government underwriting activities constituted no more than 10% of a commercial bank's total revenues. In year 1996, the revenue limit increased from 10% to 25%. The Greenwich-Bliley Act of 1999, known as the Financial Services Modernization Act, was passed under the administration of U.S. President Bill Clinton. The main purpose of this act is to officially end the mandatory separation of commercial and investment banks, as originally required by the Glass-Steagall Act of 1933. The passage of Greenwich-Bliley Act of 1999 coincided with the merger of Citicorp and Travelers Group in year 1998. Traveler Group owned the investment bank Salomon Brothers. Under the restriction of Glass-Steagall Act, the merger between a commercial bank and an investment bank could not pass. The Federal Reserve gave Citi temporary waiver to complete the merger. Within 1 year, the Greenwich-Bliley Act was passed to allow this type of mergers. JP Morgan and Bank of America followed Citi to create universal investment banks. In year 2002, the Sarbanes-Oakley Act was passed after the notorious Iran crisis. Though the main impact of this act is on independent auditing and reporting duty of corporate executives, this act also has potential impact on investment banks. In order to restore investor confidence in the reporting of securities analysts, the Act required the SEC to adopt rules to minimize the risk of investment bankers influencing equity analysts' research reports by separating stock analysts from underwriting activities. Under this Act, analysts' compensation could no longer be based on investment banking underwriting revenues. And analysts who provided elective reporting of a company were also protected from retaliation by the bankers responsible for underwriting activities. In the early 2000s, the U.S. economy experienced a great moderation characterized with a stable economy with low interest rate, and a 10 business cycle with only mild recessions. The low interest rate created a historical boom in the housing market.
The cash sheeted housing price index more than doubled from year 2000 to 2007.
The size of residential mortgage was about 3 times the market value of all U.S. corporate loans, and around 16% of mortgage loans were securitized and sold to investors in the capital market. and some of these mortgage-backed securities were backed by subprime loans of high credit risks. The ongoing increases in housing prices led many investors to believe that continually rising home prices would bail out poorly performing notes. The market also created derivative products, known as CDS, to insure investors from potential defaults of mortgage-backed securities. Derivative products rating agencies also gave high credit ratings to securities products, but they were wrong. Housing prices began to fall in year 2006. Housing defaults and losses on home-backed securities surged. Some big CDS issuers did not have enough capital to back their CDS obligations when the market collapsed. AIG alone sold more than 400 billion worth of CDS contracts. Some big investment banks got in trouble, including Bear Stearns, Merrill Lynch, Lehman Brothers. After the last financial crisis of 2007 to 2008, the Dodd-Frank Act, also known as the Volcker Rule, was passed during the administration of U.S. President Obama. The main purpose of the act is to reform sectors of the economy that was believed to have caused the subprime crisis. Firstly, the Financial Stability and Oversight Council was created to establish an early warning system for emerging financial risks. Next, the Consumer Financial Protection Bureau was created to be able to pass new laws to institutions that sell financial products to consumers. To manage the risk of securitization, financial firms that engage in selling securitized products must retain at least 5% of each debt tranches they create. Securitizers must also disclose asset-level data. Next, OTC derivatives, including CDS, are now regulated by SEC and the Commodities Futures Trading Commission, CFTC. To reduce the level of risk-taking by big banks, this act put an end to too big to fail. Banks are no longer allowed to engage in proprietary trading or act as principal investors in hedge funds and private equity funds. Under the regulation of this act, rating agencies are now overseen by the Office of Credit Rating within SEC. Okay, in this week, we have discussed the history and regulation of the industry. Thanks for watching, and we will move on to financing business of investment banks the next week.